Hello, I'm Alex Mozed, co-author of Modern Monopolies, and we are here on Winner Take All, our inaugural live stream on Twitter, where we talk about all things tech monopolies, regulation, and winner take all dynamics in today's ever-changing business environment. So we have a few topics today. We're going to kind of jump around the world a little bit. We're going to talk about the European food delivery marketplace space. We're going to talk about the e-commerce and marketplace dynamics in China. We're going to talk about music platforms and wearables and the winner-take-all dynamic there. And some new platforms that have recently gone public, like Pinterest, which just announced earnings a few minutes ago. And we're going to dive into those results and tie up with our continuing theme of essentially this platform economy. We have 70 public platform stocks in the PLAT ETF. And what does that platform economy look like? And we have some interesting earnings data to compare over these past couple of weeks with how the overall S&P 500 has been performing. So let's dive on in. I've got Nick Johnson here, also co-author with me on the book. And the first topic here, Nick, is what recently happened really just over the past couple of weeks is takeaway.com, which is in PLAT. It's a public platform company, acquired Just Eat. You're seeing consolidation in the food delivery space. You also have Delivery Hero, which would be the other big food delivery platform. And then obviously
they just
Uber
got a big
Eats.
investment too, didn't they? Delivery Hero. I think they just raised about $300 million.
But you have Delivery Hero, but now you have Takeaway and Just Eat coming together. You've got Uber Eats. And now what Takeaway is saying is that they had a massive jump in their overall orders. It's a $10 billion merger that they just announced on this past Monday. And they claim that there's a $100 billion food delivery market. I think maybe they're just saying in Europe, but I'm not sure. But you're seeing inevitable consolidation, right? Food delivery marketplaces are absolutely a winner-take-all dynamic. We have 3 or 4 dominant food delivery marketplaces in the US. You've got Uber Eats. Also, you've got Postmates. You've got Caviar, which is owned by Square. Grubhub, Public, also in PLAT. And then I think Delivery Hero is here as well, right?
I think that one of the big ones in Europe is also Deliveroo.
Deliveroo, yeah.
That might have been the one that raised around recently.
So they're kind of releasing their results this week, and $100 billion market in Europe. And they bought for $930 million for Just Eats, or 30 million euros, sorry. And their total sales grew by 68% over the half year. And Just Eat reported a 21% increase. So, I think the consolidation helps. It's inevitable. And it just puts more pressure to be that number 1 or number 2 player, because the number 3 player just not going to do so hot. Speaking of number 3 players, although not exactly the same thing as food delivery platforms, but PinDuoduo, probably butchered that name, but PDD is their stock symbol, public platform company, Chinese e-commerce marketplace. The interesting thing in China with e-com, obviously we have Alibaba, which has Taobao and Tmall, multiple product marketplaces underneath its belt. You've got JD.com as the number 2 e-com player. And so Pinduoduo is still the number 3 player. But the interesting thing is that that PDD's model is really a group purchasing model, which I think is really the thing that led them to rise to the point that they are today.
Yeah, it was a little bit different. The analogy of what they are today is a little bit like if you mashed Amazon and Groupon and some home services companies together. So they do a lot of different stuff, but the initial model was really around a kind of modified group buying model where you go and you get your friends and you can get a better deal if you all buy something together.
And so this was the interesting thing in this article on the Motley Fool was that there was reports circulating in China. It looks like there was some fake news going on. I mean, PDD recently just went public in the past year, but what the reports were saying was that PDD had overcome JD as the number 2 e-com player. And basically where the discrepancy was that PDD was basically saying that they had more daily active users than JD.com, and they had more active buyers. However, I think the purchase size and the amount of throughput, GMV, market share, e-commerce market share statistics, as we've spoken about in the US, are wrong. Those actually still kept JD.com in the number 2 spot.
Definitely unusual to see a marketplace citing daily active users as opposed to GMV as their market share metric.
Right. And that's where this deeper dive goes, which is saying that JD had $244 billion in GMV, nearly 4 times the GMV of PDD, which was at $69 billion.
And part of that too is that JD also does linear selling. They're kind of a hybrid model like Amazon. So a lot of their revenue is go to first party selling as well, which helps bring that number higher than it would be otherwise.
And you see that in the revenue, right? So JD's revenue was $67 billion in revenue, which is, some portion of the take rate on the GMV plus the linear reselling model that you're talking about. And PDD's revenue, which I would imagine, they definitely have with the group buying, group purchasing model. They're definitely going to have a much higher portion of pure 3P third-party seller kind of traditional GMV sales, which means that their revenue is going to be lower naturally, right? And so the discrepancy here, there's a 4x difference in GMV, and PDD had $2 billion in revenue. So it's, a 33x difference in revenue figures. And that's real. I think that's attributed to what you're saying, which is kind of the linear revenue, platform revenue split on a JD versus much more platform revenue.
Like almost all platform
on a PDD.
Revenue.
Yeah, almost all platform revenue. But still, I mean, even if you look at PDD's GMV of $69 billion and they're earning $2 billion in revenue on that, I mean, a 10% take rate is $6 or $7 billion.
Yeah.
So their take rate is not very good compared to particularly any kind of US comparables by any measure. If you look at an Amazon Amazon probably takes 5 to 15. I would say from some third-party sellers I know, they're saying it's probably 10 to 20, but I'd say actual take rate's probably 5 to 15% on an Amazon. And then you have to account for all the fulfillment and rent and storage fees that Amazon tax on. All in, it's probably close to 15 or 20% net fee that Amazon's taking from its third-party sellers at this point. So, I mean, moving back to the US, let's look at Apple and Spotify. So just this week, Spotify and Apple subscriber numbers basically was announced that Spotify still has a big lead over Apple Music. Spotify has 108 million subscribers and Apple Music has 60 million subscribers. Now, to clarify, this is not a platform model, right? These are very linear businesses. There are maybe, less than 5 music labels that control all of the music inventory that's out there. Spotify had tried to let artists publish content and music directly to the platform, but from what we've been hearing or seeing or informed, it seems like that initiative was actually not taking off as much as I guess they had hoped.
I think also it makes the record companies that do control a lot of that supply very unhappy. So I imagine they got a little pressure put on them to not piss off the people that supplied 90% of their content.
Mm-hmm.
You have seen them going more into podcasts and other things that are much less consolidated and much more fragmented than the music industry. So I mean, podcasts is an example of that, where they're really investing heavily to try to build up that ecosystem. They're buying podcast companies, but also trying to become a destination for other people to upload their podcast content that they can get, exclusive or unique content on Spotify that they don't have today, and which is very hard to do in music, just given that consolidation.
Mm-hmm. And I think, now the other thing here with the music dynamic is that Spotify is saying they had 232 million people use its service at least once a month, which includes the free tier.
Right.
So, that's a very large discrepancy, 108 million to 232 million. I mean, I don't know what I make of this, right? 60 million subscribers from Apple. Given Apple's huge advantage, because they own the platform, on iOS, and
they also can't. They don't exist on Android, so it's an advantage in one area and a disadvantage in others.
And they don't exist on Android. Is that true?
I don't believe so.
Wow.
If they do, it's fairly recent. I know they didn't, at least when they launched.
Yeah, that's interesting. But they don't get a 30% hit take rate that
Right.
Spotify does, and so I guess 60 million makes sense, but
I mean, a fair amount of those too are trial customers. I imagine people that get that first 3 months free. Haven't canceled yet. I think they probably include those in their subscriber numbers.
yeah, join Apple Music on Android. It exists.
It does. Okay.
Yeah. So I don't know.
I doubt they have a lot of users of it, but you never know.
I feel like Apple's done well with Apple Music in this arena, but I feel like honestly they should have been able to have done better. Now that they've been in this for a few years, now they have such a huge advantage. And look, let's be honest. Spotify sued Apple a few months ago over playing unfair games with the
Pricing
restrictions and suspensions that they were giving to the Spotify app,
Right.
Versus advantages that they were giving to the Apple Music app. And this is where platforms get in trouble with tech regulation and the like. But the other arena that Apple, I'd say, has done very well in is the smartwatch area.
Yep.
So just this week as well, definitely a winner-take-all market in smartwatches. Smartwatches have much more of a platform dynamic than the music industry, right? Where you do have apps and you have
third-party developers. Not as much scale, certainly, as the iPhone. Probably
not as much scale, not as much utility.
But you do have a lot of apps being built for the Apple Watch. You have a lot of health apps and other things that are extensions of iPhone apps. There's a lot there.
And so this is what I thought was interesting. So Apple's wearable business, which includes more than just Apple Watch, includes AirPods
Right.
and Beats headphones. But nonetheless, it had a 48% growth this quarter compared to last year quarter, right?
But didn't they say it would be like a Fortune 100 or something company on its own?
It is,
if it were that wearable business were a separate business.
$5.5 billion in revenue. And I think those are quarterly numbers. Compared to Fitbit, which is at 4.8% growth
Right.
at $313 million in revenue. I mean, so there is a huge discrepancy here. Even if you take out Beats, which I forget what their revenue was, but it's probably around a couple $2 billion or something like that a few years ago when they were acquired. And AirPods, I mean, there's still the lion's share, I think, or a large chunk of this revenue is certainly being attributed to the Apple Watch. And the fact that, it's harder for especially on these more nimble devices where the compute power, really that kind of integrated approach that Apple brings to its products. I just feel like on these kinds of devices, we're clearly seeing the integrated approach outpace the Android model, the more open model, where it's just, you can have third-party OEMs and they're going to build on the Android operating system for this, but
the screen real estate is also just so small. It helps to have a standard device format for that. It becomes much harder to deal with so many different device sizes and formats when you really only have, this much room to deal with.
Yeah. So just 10 minutes ago, Pinterest, which just went public a few weeks ago, they did a direct listing. Technically, it's not an IPO. We also saw, Pinterest, went public a few months ago. It was Slack that just went public a few weeks ago. Also a platform company. Both did direct listings. So Pinterest has had a huge beat. They're up 15% now in aftermarket trading. And they were expected to lose $39 million. They only lost $26 million for the quarter, but their revenue was a huge beat, which was expected at 236, and they came in at 261. So on an annual basis, that puts them at over $1 billion in revenue. And their monthly active users rose 30% year over year to 300 million. So it's really interesting, I think, in the content arena that, and somewhat similar to what we were talking about with PDD in e-commerce in China. There are winner-take-all markets here, but I think it depends on how you define what the winner-take-all market is.
There's niche use cases and niche content platforms that pop up the same way you have niche marketplaces They address certain types of user groups, certain types of user behavior that a YouTube or a Facebook does not.
Yeah, exactly. Just like you can have StockX and Goat, which both reportedly on a pro forma, forward-looking basis, if you take their most recent quarter GMV and extrapolate that out into the future, they would peg themselves at over $1 billion in GMV in the sneaker secondary market resale industries, right? So there's definitely these overall giant, dominant, winner-take-all content platforms or marketplaces, whether that's in products or a variety of different spaces that we're seeing. But yes, these niche, you can still have a multi-billion dollar, very successful platform business that does have a winner-take-all dynamic. It's just in a more refined sliver of that industry. So congrats, Pinterest and team. So, and this dovetails into the ongoing topic of the platform economy. And there are 70 public platform stocks. That's globally. But in our previous episode, we were starting to look at, there are 21 public platform stocks that are in PLAT, the ETF, that are also in the S&P 500.
Right. Those 70 stocks that you mentioned globally, there are 70 stocks, 2 billion in market cap or greater, that are listed in the US and Europe, no matter where their business is actually operated. Well, they're not listed in China.
Oh, yes, but they have reciprocity in, yes, US or Europe. 21 of the 70 are in the S&P 500.
Right.
The newer companies that are IPOing now, they literally just can't be in the S&P 500.
Right. It takes a couple of years to get there.
But over half of the 70 public platform stocks today literally weren't public 5+ years ago. So these things are so new and they have such growth in front of them. But what we wanted to do is take a look at the earnings dynamics here. So if we look at all of the S&P 500 stocks, quarterly net income, right? So aggregate net income earnings for, now this is looking at Q1 here, you can see. So Q1 blue line is at about $316 billion. This aggregate net income across all of the 500 companies in the S&P 500 for Q1 of 2019. Now, the interesting thing is that then when we compare the 21 platform stocks,
just under 5% of the S&P 500,
just under 5% of the companies in the S&P 500, and the earnings that they have, basically what the calculations come out to, it's a little over $43 billion. Now, this is actually the data from the most recent quarter, so technically from Q2. So it's not exactly apples to apples, but you get the point, right? You have roughly $40 billion in aggregate earnings from the 21 public platform stocks in the S&P 500, which, do the simple math, $316, $43 billion. It's let's call it 15%, roughly, 7th and 8th, somewhere around there. That if you have a little less than 5% of the companies accounting for around 15% of the earnings. I mean, I think that is just one small example of the earnings potential and the growth potential of platform businesses and how new they are. I mean, look at these platform companies that are in the S&P 500, by the way. And if we were to look at founding dates and IPO dates, you have companies like Copart in here. Copart has been around for decades. eBay, Expedia, Salesforce, Google, ICE, so they own the New York Stock Exchange.
Yeah.
MasterCard, Market Access. They just are joining S&P 500. That was just announced in the past week or so. NASDAQ, PayPal, TripAdvisor, Twitter, Visa. Really, none of these companies are new. Maybe Market Access is probably the newest company. Facebook's in there. CME Group. These are both CBOE Global. These are investment platforms that have been around for ages. Booking.com, Amex, Amazon, Apple. They're not new companies, right? And I think what we predicted now, when was this? Many, many years ago. It's actually published on Tumblr. That's how you know how old it is. June of 2015. Pre the book coming out. Book came out May 2016. This was while we were really building a lot of the research for the book. What we said is in 25 years, 50% of the S&P 500's net income will come from platforms. I'd say we're entirely on trend for that. We are 4 years into our 25-year prediction. We're at 15%. And when you look at the platforms that are actually in the S&P 500, they've been around forever, right? We're not even counting all of the platforms that have just come public in the past year or two.
Yep,
Which if
you've got at least half a dozen, I would say, that'll be candidates for it within the next few years.
Right. And that's really the growth cycle, that even though you have SoftBank, even though you have these mega VC deals that are essentially pushing out the date that they go public, and also really those mega VC deals are, I think, part and parcel as to why companies like a Slack can do a direct listing, and they don't really need the capital,
Yep.
but really they're just trying to get the liquidity. It's good for their employees,
investors,
their investors, and it just makes them a stronger company. It gives them more liquidity. They can get debt more easily, all these kinds of things. It just makes the actual strength of the company much better. So it makes sense. But even with the fact that companies are necessarily going public later on in their life cycle, and then they are able to burn through cash a lot more aggressively than say an Amazon could have when it was getting off the ground. These companies have yet to really turn on the profit engine. They're still really in heavy growth mode, and they haven't really gotten to the point where they say, I'm going to turn my monopoly, their monopolies, into a cash cow and really start turning on the profit. I mean, look at an Uber, look at any of the companies that have really started to go public recently. Eventually, Uber and all these companies are going to get there, especially the ones in the number one.
Maybe not all of them.
Yes, especially the ones that what I would say is in the number one spot. And Uber in the number one spot. I think a Lyft is going to have a much harder time. A Pinterest, which I think really owns its own niche very nicely.
Yeah.
And there's competition, but it's not. It's maybe overlapping. It's not as direct. We'll continue to add more information, kind of cataloging the platform economy. But this is very interesting as we kind of dig into this information. So. Now, this is from a couple weeks ago that Walmart announces an executive shuffle to further integrate stores and digital. This really kind of came out right after that Recode, the Vox Recode article.
Yeah. The whole internal brouhaha around Mark Lohr's team gets too much credit and they're losing money. Why are they getting credit when we're making profit in the core business?
And that was maybe episode 3 or 4 that we were talking about. Doug McMillan's response to that, yep. and what his great line was, look, at the end of the day, we're all friends, and there's definitely, look, the reporters definitely have a bias, and media companies are hard to make money these days, but look, all that said, it's not easy to do these changes. It makes sense that there can be some egos that are bruised or some discontent that might live underneath the surface, but I think Walmart's going to continue down its path and is continuing to make the right moves. Now, so what this is saying is they're really consolidating the supply chain part of things. And I think that also makes sense when you look at a lot of the point of discontent in that article was that Walmart is losing $1 billion a year in e-commerce.
Right.
And really the reason why they're losing so much money is to invest in infrastructure. They've got
fulfillment capabilities,
20 fulfillment distribution centers. Amazon has 5x that, and they need to play catch up.
Yep.
So when you kind of look at needing to bring these things together from a supply chain standpoint, that makes sense. When you look at, now here's the interesting thing. So the guy that they are consolidating supply chain stuff under, this guy, Greg Smith, he is now going to jointly report to the head of Walmart US and Mark Lohr. So I think that's going to be really interesting, and and I'd say Greg's got a little bit of a tough job there in terms of figuring out how to balance these two. What are definitely share synergies, priorities. But there's definitely some competing priorities, right? The beautiful synergies are how the US stores are doing the pickup in store, which is able to now drive more e-commerce purchases, and then you pick it up in store.
Right. And then if you go to pick it up, you might buy some other things. So it's also driving foot traffic into those Walmart stores.
Yeah. So there's definitely synergies between the two, but there's also definitely some competing priorities and budgets.
Certainly in
things.
terms of time horizons and budgets, the core business is there to make money. And then the growth initiative needs room to make some investments and prepare for the future. So there's always going to be tension there, but that doesn't mean they can't coexist.
Now, this is interesting. So this just popped up on my screen. So we'll end on this note. Defense Secretary is reviewing the $10 billion Pentagon cloud contract after Trump says it unfairly favored Amazon. The irony in this whole JEDI contract is this. They're spending $10 billion for a commoditized product. What is the business model of AWS and Azure and Google Cloud, right? It's, yes, you're selling the cloud storage as a service, and those servers, that's a linear revenue line item, right? Those servers are on your balance sheet, and then you're selling out the storage.
They're in your server farms that you've got all over the world.
And but the real differentiator, and we mapped this out a few episodes ago, the real differentiator is on the third-party apps, the integrations, the additional utility, that ecosystem of third-party app developers. And Satya at Microsoft has been adamant, not as aggressively as a Steve Ballmer developer chant, but still, he's on the same line of thinking that Steve was on,
in his own way.
Yes, in a much more cool, calm, collected, reserved manner. But it's the same line of thinking, right? That's what Satya has been able to do so brilliantly is provide multiple avenues for this existing developer ecosystem. He's been able to tap into the existing developer ecosystem at Microsoft that has been building on, Windows apps for decades and forever. Now they have already been ahead of Apple in the sense of now trying to unify the operating system across their PCs and the tablets.
Yep.
And now, again, make that easier for developers. Apple just announced that they're going to do that, I guess, by like 2021 or 2020 or something.
I think they announced it a little bit earlier this year, but that's still a ways away.
Right. But going back to the point of apps, right? Who is the number one in cloud storage as a platform model? It's AWS.
Yep.
Number 2 is Azure. Number 3 is Google Cloud.
Distant number 3.
Distant number 3. And if you literally go up and look right now, how many apps, third-party apps exist on the AWS marketplace or Azure or Google Cloud, it'll literally go 1, 2, 3 in the same order of market share. And it's simple, right? I mean, where is the most demand? And then you're going to get the most interest from third-party developers to make investments, put time, money, et cetera, to make apps to sell to those customers. The problem with the defense contract and the problem with JEDI is they're just getting the cloud storage. They're not doing this. I guarantee they're not doing this in a way that's saying, man, what if I could now open up APIs? What if I could now enable third-party developers to build apps on top of all of the data that I'm going to be storing in my secure cloud? As the Defense Department.
Right.
And if you want to talk about lethality, oh my God, you want to talk about creating software for the military? Yikes. Okay. What software developer wakes up in the morning and says, I want to go make an app for the military? You have RFQs, RFPs, you have to spec everything out, talk about waterfall. I mean, it's the most miserable process in the world to create software for the military. Everything is spec'd out. The idea of like agile development, I guarantee would blow their minds. We think that agile development in big traditional enterprises, private, or non-government entities is a big deal. Talk about moving that to the Defense Department. Just think about all of the use cases that if you're a Marine and you're on the front lines, or if you're in the command center, or if you're an analyst, the ability to create innovative software that allows you to analyze data in new innovative ways, actually maybe control a drone or maybe some non-lethal machinery in ways that would just be so arduous otherwise. But if you can now open up APIs and allow the community of developers to say, I'm going to create software for what I think the needs are of the users in the US Army and Department of Defense. And then you provide a budget to these users and to the departments to have an app store for the military and for the Department of Defense, and they can vote with their dollars. and they can say, hey, this app was amazing. You predicted the demand. You predicted the need of what our troops need. Very well, app developer. You will get rewarded with an outsized amount of compensation, as opposed to, I don't know, however many hours it took you to make this thing, and right, you made it to spec. And
introduces an element of actual competition and innovation into the military software development process that isn't quite there as much as it could be at the moment.
It could be there so much. There are so many areas of low hanging fruit. I don't even need to talk about getting into weapon systems. Okay. But low hanging fruit, we are just now improving the user experience. You're allowing the different members, which are, by the way, millions of people in the Department of Defense, $700 billion budget. Right. I think, why did they brag about the stats? It's like FedEx and Delta and 5 banks and Walmart put together, and they still have more people. It's a lot of people. And why don't we have a creative development community there?
There's no reason they need to be second-class citizens in terms of the software they have access to.
And so this is the irony. Now, what would I do to Amazon or to Microsoft or Google that want to get in on this contract? What I would say is, I'm going to pay you $5 billion, but you can take a take rate on the software and the money that people spend on the software created by third-party developers. And that is now going to incentivize Amazon, Google, Microsoft to try to make sure that during this implementation process, which I guarantee is going to be a nightmare, by the way, if it's $10 billion for the hardware, it probably costs them $30 billion in implementation. But anyway, how are you implementing and coordinating and organizing this data in such a way that you can open it up and make it extensible? And that's the true value prop of moving to the cloud. That's the true value of what we've seen now with Salesforce and their app marketplace, which is doing $1 billion in revenue off of a total of a $10 billion top line for Salesforce. But that $1 billion in revenue is accounting for over a third of Salesforce's net income. The app marketplace dynamic is absolutely critical to any cloud Jedi deal here. And it's so far beyond the folks that are negotiating this. It's just really unfortunate. So on that note, it's 5:02. We'll leave you. And welcome to August, everyone. Thanks for joining us on Winner Take All.